Today, the weather is changing on valuations. Hello again, it's Martin North from Digital Finance Analytics, what latest post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by property insider Edwin Almeida. Hi, Edwin.
How you going, Martin? Hope you're keeping well, hope you're keeping healthy and you're staying out of trouble.
I'm hanging in there by my fingernails, I think, at the moment. It's extremely busy. We've got a lot of people who want to talk about property down at the postcode level and trying to get us handle on what valuations really are. And one of my observations that's coming out again and again and again is that they are being fooled by these generic high-level indices that are being quoted in all the media and and on the portals. And when it comes to having a real conversation about real property, the real story starts coming out, and the real story is way different from what these indices are telling us.
Look, definitely, Martin. It's quite intriguing how even the Australian Financial Review put out a proposed solution to let's say averting the mass number of potential mortgagee sales that could come post the holiday period that the banks are giving the mortgage holders, and their proposal outside of banking regulations and policies. Let's talk about one, who's going to value it? How are the properties going to be valued if they took on that option? And two, they're also let's talk about they said share of future capital growth.
Right. Well, let's just explain, because people might not have seen the articles. So just explain what the AFR is proposing.
Well, they're proposing that I call it a JV between the mortgage holder and the bank, and they hold title to the property. And what the writer says, the author of the article says, is let's say the property is worth $600,000. So they hold $300,000 in equity. Paid to the bank, and $300,000 is owed to the bank, rather than because the person holding the mortgage may be under mortgage stress and not able to meet the repayments post the holiday period. Well, let's go into an equity share scenario. Now, the author doesn't say who's going to value the property. So in this case, to assist the mortgage holder, I would vouch for that we use the hedonic valuation, because the hedonic predictive valuation is going to be much in favour of the mortgage holder as it is to the bank. The bank's going to say, oh, no. Well, we're going to use an independent valuer, which the independent valuer will use all sorts of medium to come up with a more realistic value. And the more realistic value, unfortunately, is going to be perhaps $500,000, being generous. So realistically, the mortgage holder is going to have a $250,000 position in the property, and the bank's going to have a $250,000 position in the property. That's in terms of valuations. So I dare say, Martin, that if we did go down that path, as the author of the article writes, the bank's going to want to use the independent valuer, which will be more to real, because independent valuers that walk the beat, that are on the ground, that see transactions, that talk to real estate officers, pretty much what I do as well, and what I see happening at auctions, at real sales, and the way that we obtain the actual sales that are not advertised, of the sold properties, the sales, the prices that are not advertised, we can get our hands on by different means and ways. We know what's really happening. So that's how it's going to be, and that's going to be a rude awakening. That's on point one.
Right. And so that, the whole idea is to try and reduce the pressure on mortgage holders by reducing the amount they have to repay in terms of the monthly installments on the mortgage, right? By effectively somebody else taking an equity share in the property, and therefore, if the property goes up, then presumably everybody wins. If the property goes down, everybody loses. Now, I got to say, my sort of thought was, well, that's okay, but hang on a moment. If I've got a 10%, deposit on my account on my mortgage at the moment, so 90% is owned, owed by my mortgage. I now sort of rejig this, and basically a proportion of it turns into an equity share, so I don't have to pay back so much, right? It seems to me that I, as the mortgage holder, is probably going to lose out.
Well, you lose out if on the real valuation, which is not what the hedonic, what the mainstream media and the RBA and what a lot of the institutions want to hang their hat on as to being the true account of what's happening out there in the real world. The real world paints a different picture where the mortgage holder will lose out, and will lose out a lot. But the author of the article alludes to where inevitably the mortgage holder has a substantial stake in the property. But like I said, if we use the hedonic, in this case, I would love for them to use the hedonic predictive valuation, because then the mortgage holder comes out on top of the bank. But it's not. You and I know that it's not going to when the rubber meets the road, and when real numbers have to be presented, they're not going to use the hedonic. The hedonic's going to be left by the wayside, and real valuation is going to come in. It's what we can see that a lot of properties have dropped, 10, even 15% in some areas already, and they will continue to drop. Which leads us to point number 2, Martin. So the article, and the author of the articles proposes that then later on in years, then the banking institution and the mortgage holder can then share of the capital growth. I mean, I would have put there, rather than how many years, I would have put how many decades personally. But hey, that's I wasn't the author of that article.
Well, the point there, of course, again, is that we should not be deluded. The run-up in prices that we've seen over the last 20 to 30 years is abnormal if you look at the long-term history cycle of prices in Australia. And you can point to it being related to cuts in interest rates, lower lending criteria, lower standards effectively, so you can get more, more in the way of borrowing, higher multiples, all those sort of things. Deregulation of the financial system, pretty much wherever you look, there are a lot of things being all turned in the same direction, which allowed the household debt ratios to go through the roof, which allowed property prices to expand. But given where we are, with unemployment now looking in real terms probably close to 13%, according to the latest from the Treasury, and the fact that this is going to be a long, slow grind back to a recovery, even if we get the virus under control, and the fact that interest rates are now rock bottom already, so they're not going to drop much more, and it's going to be hard for the banks in the current environment to lend at even higher multiples that they have traditionally been doing. You've got to say it's unlikely that property values are going to start going up anytime soon. In fact, my own modelling is suggesting that the next 3 years sideways or down, depending on what types of property and particular postcodes, and it does vary, I understand that. But I don't think that we should say, it's going to then start going up the same as previously. In other words, we're going to see 16%, per annum increases like we saw at one point in the last few years. We're in a whole new ballgame.
Yeah, it's a new game. It's new rules. It's not only a new game, but it's also new rules. And as you mentioned earlier on, all the things that are working against the property market at the moment. And you've got obviously your international travel. Then you add on to that the stress that businesses, the SMEs are under at the moment. You've got added to that is you've got to ask the question: Are the overseas Chinese investors going to return? I say no, they won't. And there's a lot of data in mainland China that is pointing to that, for the government pushing against having any favour whatsoever with Australia because of the position that we've taken. I think the only thing we can hope for, Martin, is that everybody from Melbourne, because of the extension to the lockdowns, to the emergency. The state of emergency thing that they've now proposed there, I think we can only hope for is that we get more Melburnians back up here into Sydney. Maybe that's going to assist the value of property. I don't know. I'm just shooting the breeze.
Well, but isn't it true, according to some reports I was reading, that there are Melburnians who are actually buying Queensland properties sight unseen over the internet at the moment? That was going to be the next great saving thrust for property in Queensland.
Yeah, I made an offer on a property in Queensland for a client of mine, sight unseen. Yeah, they were asking 1.5. I offered them 700. Haven't heard back from the agent. I don't know why. I really don't know why. I gave them all my reasons as to why I was offering that, and I thought it was a very generous offer at that. Now, realistically, I think one out-of-line sale doesn't make a market, and that's what we're getting at the moment. We're getting a number of out-of-line sales in certain suburbs, and the other thing, which this is the narrative that the mainstream media take, is they take one sale or one auction that the agent reports that they've achieved 200, 300, which translates into 20, 25% above reserve sale price. They take that as a positive sign to market changes. Little do they know that these idiots that promoted these properties in the first place shouldn't have had the job to promote the property, because they've underestimated the value of the property. We can allegedly say they underquoted, and I'm saying allegedly, because they haven't been convicted, although they should be hit across the head with a baseball bat. But one or two things, Martin, is that they've underestimated the value of the property on purpose, or they really don't know the true values of properties in their area. And that's my second position. Why should vendors give these idiots a job to sell one of the most valuable possessions? I don't get it. I don't understand it. It's a strategy that may have worked with the market going up, but it's working against them with the market going down, which is good now for buyers, because if they want to start auctions where they want to get a sale at $1 million, and if they want to quote $800,000 for in the price guide, well, you go in there and you offer 600, and you start the bidding at 600. And if the agent or the auctioneer says that that's too low, you start saying, well, if the agent says it's only worth 800, why would I want to pay more than 800? And if anything, I want to pay a lot less than 800. So it's working against them, and this is what happens, Martin. The narrative will change, because more and more people are wising up to, vendors are going to start wising up to these strategies that aren't working for these selling agents.
Yeah, well, I agree with that. And also, Edwin, the other observation, because I've been doing a lot of this research now at a postcode level for specific people who are engaging me, to have a little bit of a dig at a postcode. And one of the things that's quite astonishing is the difference between the advertised asking price and what the settlement price actually lands on, right? And typically there's an 8 to 10% drop, right? Not universally, but typically. And I've noticed that in the last few months, that drop has actually got quite a lot bigger than it was previously. So it was a little bit more buoyant a few months ago before the virus, I guess. But, first point is there's a drop. Second point is it amazes me how many prices are now not disclosed.
Yeah, they're withheld.
Yeah.
For that same reason, is that the narrative that it has got to change. The conversations between the agents and their local clients have got to change. They've sold them the story that the market's strong, that the market's going up, and they're waiting until the mainstream media start telling another story so that they can use that to go back to the clients and tell them that the market is actually descending now, and it changes, and it takes a bit of time. The post that I put on Twitter and the auctions that I put up on Twitter, if I didn't go to, if myself and my associates, if we didn't attend as many auctions as we do on the Saturday, we will know, as closely as what we know, what values in some areas, in some the areas that I'm looking at specifically myself. for my clients, I can see the trends, and the trends, as you say, Martin. In some cases, the difference between what the hedonic says, what the guide says, and the actual a price being transacted, you could say the hedonic is at 30% above the actual transacted price. The agent's guide is 15% above, and the actual transactions at 15% below. And in terms of more pinpointing the actual numbers that the viewers can sort of try and wrap their heads around a little bit better, is so a lot of these transactions that I am seeing are pre-2016 purchases. So some properties are now falling below what people paid in 2016, 2017.
Yeah. Well, you may know, I don't know whether you've seen it, but I did a show some time back calling Property from Soup to Nuts. And I went through a whole series of examples of where properties were actually listed for more than they currently are, right? And people accuse me of cherry picking, specific examples. But it was blooming easy to cherry pick because there was a whole truckload of cherries. I mean, it is happening, and it's happening quite significantly, not uniformly, but quite significantly in multiple places where people, for various reasons, are now having to settle at prices well below where they were a few years back. And interestingly, of course, the mainstream media really doesn't cover this at all well, because they always pick the ones where in fact it was above where it was. But as you say, if you start off on a low base, an artificially low base, then bingo, you get a price above. But that doesn't mean there's actually anything other than just a misrepresentation on day one as what perhaps the value should have been. So I mean, all of this is part of the stupidity that's going on at the moment. And the other thing, of course, is that all of the other spruiking is about all the property markets are now bouncing back, like Western Australia. Have you noticed how the diary cards come out for the next 3 months? Right, we now need to publish the next article to say Western Australian property is now recovering again. Now, if I had a dollar for every time I read that over the last few years, I'd be quite rich. The fact is, there's very little evidence other than, of course, the home builder thing, which has given a big kick to land home packages. But it's really done that at the expense of existing property over there. So there really is very little evidence to suggest other than we're in a sort of a long, slow grind. And by the way, volume's still pretty low.
Yeah, look, volumes are low, although they haven't retreated over the winter period as we've been discussing. Where the last couple of weeks have been. I haven't seen as many as what I expected. Admittedly, I expected to see at least 9,000 freestanding homes for sale on the market in the Sydney region, and above the 19,000 overall mark for sale properties overall in the Sydney region as well. It's been a little bit slow, but I think it's taken time. I think people have realised that. In order to get the best value for the property, the property's got to be tidied up a bit. They can't just put anything on the market anymore and expect for it to get top dollar. So they're expecting that, and because of COVID, and because things have been a little bit slow, and some trades have been inundated with a lot of work. For that reason, to prepare these homes, they haven't been able to get them on market. So I'm thinking in the next couple of weeks we're going to get a whole dumping of property. But there's a lot of other factors out there that you and I have discussed that could potentially really create a massive avalanche of listings on market, and that is what's happening with internally in China with people that have got money tied up in there. I know a number of my associates that deal with overseas investors and the like. They've got money. They want to bring it over, but to settle permanently here in Australia, and they're because they've also got permanent residency here as well, and they're going to make this their permanent home now. But the thing is, they've sold their assets over in China. But guess what, Martin? They're having a very difficult time to get that money across to Australia, and it's a watch this space with what's going to happen over there. That's one of the key elements. And then there are the people that can't settle here in Australia. So I'm thinking that there's still going to be a massive of people that will offload their investments here, particularly the ones that bought are more interested in the freestanding homes. Because that's going to create a lot more carnage. That's going to create a lot more pain for in regards to the local property market, and these are homes that were bought dubiously through by circumnavigating the Foreign Investment Review Board regulations and legislation, and there I can see in some pockets of Sydney that they are being put on the market, but I'm still expecting a lot more to be put on the market for that reason. And then you've got the retirees, Martin. They've got no choice. That's a generation that has been left behind. They've got no social media presence as such. They've got no real voice as such. They don't contribute by way of tax anymore, because they've retired. They're moving on to the next cycle of life, and it's only a matter of time before we see those properties on the market that they've held for 30, 40 years. So it's a watch this space. And you know what, Martin? It's only going to take. It doesn't take a lot of properties in each suburb to really further turn the sentiment around. As I've been saying to a number of my clients, an extra 3 or 4 properties in each suburb, and there's a lot more choice, and the buyers aren't there.
Yeah, just on that down trading trend, and it's one that I've come across quite significantly over the last few weeks as I've been talking to individual people. Quite a few of them are quite concerned. So there are 3 things going on. The first is they're sitting on equity, right? And they're worried that equity might get eroded if prices fall, as we're both predicting, right? Secondly, they've been in receipt of income from term deposits and from share dividends, right? And effectively those were buttressing their incomes. So effectively they were scraping along but just getting by. Now suddenly term deposits have gone through the floor. You're lucky if you get 0.25% on a call account and not much more on a term deposit. And of course a number of major players in the share markets are now not paying dividends or paying much reduced dividends. So suddenly they've got this income crisis that they're being confronted with, right? And so the dilemma for them is, do I sort of ride this through and hope that prices come back up in a few months, if everything bounces back, V-shaped recovery and all that? Good luck with that. Or do I try and sell quickly to be able to release that equity so that I can then at least have something that I can keep for my later years as I move into retirement and beyond? And that is a devil of a question to deal with. And, the complexity is, as you say, you only need a marginal movement of supply and demand in a particular postcode to have a massive impact on the achievable price. And we're already seeing that in some areas, I think. So I think the down traders are really the other people to watch. Plus, of course, the property investors who, in my surveys, are really now getting really big cold feet because rentals are down, in some cases down 10%, compared to quite recently. The capital value is going down. And the problem, of course, is they still have to make these mortgage repayments if they're leveraged up, as many of them are deliberately. And the other point to make is that as the interest rates have come down, of course, the negative gearing credit they got is getting less, right? So effectively the whole philosophy about property investing doesn't work anymore. And in fact, I've got more and more people in my surveys who are now in negative net returns on their investment property, and no hope of that turning around anytime too. So, whether you look at down traders, whether you look at property investors, whether you look at overseas purchases, all of them are effectively going to be a negative driving force in terms of the property momentum, and that leads to one obvious conclusion.
Yeah, a glut of property, an avalanche of property on the market, a decreased pool of buyers, and it's going to be a smorgasbord. Things may have been delayed by a week or 2 weeks or a month or 2 months, or in this case, as I said, I was expecting already about 9,000 listings in the Sydney region, and 9,000 isn't a lot in comparison to previous years where we would have been closer to 13,000, 14,000 freestanding homes for sale, and we wouldn't have flinched. Overall sales for the Sydney region and the domain would in spring we would reach upwards of 25 to 27, and these are to be transacted, not ones under offer. And I'm not, there's obviously a lot more for sale, but I'm just using the domain Sydney region as my benchmark, because it has it depicts a better region of Sydney. But yeah, look, it's going to be, which one is going to be which one is it going to be a trickle effect from all these different areas that are going to increase the supply of property, or is it going to be one dumping it? I think it's quite frankly, I think it could all come unhinged all at once. It's really a wait and see. But I'm not seeing what the mainstream's projecting, other than I look very closely at the sales that they do use to talk about the market recoveries and the like, and I look at, when you start dissecting that the sale in Punch Bowl of a house that was listed at $750,000 reserve went for $1.2 million, and everybody's doing a song and dance, I would absolutely crucify that real estate agent for not only for underestimating the value of but not. If he says, "Oh, he didn't underestimate the value," that's what it was. Well, you dipstick. Why weren't you aware of the fact that it was a R4 zoning, and if you acquired the block next door, you could put a block of apartments there. So you've got to dissect everything. As you say, Martin, you've got to really dig deep into these listings, and that's what we aim to do out in the field, and hopefully I'll be able to report to your viewers on a weekly basis and let them know to see what's happening at a granular level or on the ground in and around Sydney.
Yeah, well, that's right. And so we should explain that what we're going to propose to do is to make a series of weekly shows, probably on a Monday, which will actually review the results over the previous week and over the weekend, because we think that there is a very, very important story to tell about the volumes and the transactions and the listings, and frankly the mainstream media is not telling it right. So expect that to be as effectively from next week as we move into the the spring season, and into effectively September and beyond, because of course what happens over the next 2 to 3 months will be critical. Bear in mind also that now there is pressure from a number of banks talking to those people who are in principal interest repayment holidays, who haven't yet got a sense of their income coming back, and basically the banks are now going to be putting a bit more pressure on for them to sell. So that's another factor to take into it. So tracking the listings volumes, tracking the sales volumes, and indeed even the auction clearance volumes, and trying to get a read as to what's happening, I think will be extremely valuable. And so I look forward to having that conversation with you, and we'll try and get them up on a Monday evening to give people a bit of a sense of what happened over last weekend. And that will also give us a chance also to think a little bit about trajectorily what we think is going to happen over the next few weeks, because as you say, and I keep repeating, this is a very fast-moving, dynamic situation, lots of moving parts. The simplistic top-level stories that we see out there in the mainstream media is just doing nobody a service. So we're going to try and help fill the gap.
Yeah, look, definitely. And I guess one of my followers on Twitter put out and asked me a question as to what was my vested interest in watching the market collapse. I really started thinking about that, and I thought I was being more informative than really portraying any type of form of vested interest, because if the market drops by 30%, drops by 40, 50%, whatever the case may be, across different assets and different areas, look, I want to put out to the general public, to our viewers and followers, and that is that myself, my family, we lose equity as well. So in terms of we're trying to inform the general public, put information across, tell them what's really happening. Now I've got people that have contracted me to help them buy a property in this space at this time. I don't question. We have our conversations, and different people have got different reasons why they need to buy or want to buy, or they feel they need to buy. I'm not there to talk them out of it, other than help them in the system as best I can, and put together put forth information, and that would hopefully assist them. And the people are going to be transacting when the market goes up, and there's a number of people that also transact when the market goes down. So going back to what's my vested interest is really just to keep the public informed, and I enjoy that. If the property values go down, well, guess what? Myself and my family will lose as well.
Well, just so here, because I have a property, and to be very clear, I have no vested interest at all. In fact, somebody sent me a message the other day saying, when the property price market has collapsed, will you then close DFA because you'll have nothing to talk about? And I responded, well, no, actually, that's not the point. The point is, whether it goes up or whether it goes down, it's the dynamics and it's the the movements and all the moving parts, which will always be there. Which means that what we're trying to do is cast some sunlight into a dark corner of an industry that really doesn't really want to be seen to be out there in what they're doing. And what we're trying to do is educate and inform and help people to make better decisions, whether the market's going up or going down or going sideways, right? Because what this is about is trying to provide a better lens through which to see what's going on than the high-level spruiking that's out there in the mainstream media. And I can point to thousands and thousands of articles over the last quarter, all pointing in the same direction, all from entities that have absolutely massive vested interests, media companies connected to real estate portals who will actually benefit if transaction volumes increase. I mean, that's so vested interest as to be way there. Or indices companies that effectively get paid big bickies by many organizations to be able to take that data and go use it, right? Vested interest? Well, I think that we have much less vested interest than many other people. And, I sometimes say objective, independent, data-driven is what we're about.
Yeah, to finish up on that point that you've raised, there are some so-called property reporters across the mainstream media that have said that 1 or 2 years ago they themselves were bearish on the market, but when the wives, and I say the partners, I shouldn't say wives, it should be politically correct, and say when the partners encouraged them to purchase a home, all of a sudden they stopped talking about the falls and started all of a sudden relying more on the hedonic and its predictive gauges. I mean, and there are people in there that they've got their partners that are pushing them to buy, so they've got to psychologically, or they've got to create an illusion in their heads themselves that the market isn't going to drop as much or isn't going to do this or do that, because whether it be a financial interest or whether it be an emotional interest or whatever, they'll change the narrative. I don't think you and I have changed our narrative, and I give the real estate agents a lot of stick because they don't disclose the information that should be readily available. The portals. They don't disclose. They've got the richest form of data, live data that could be of great benefit to the society, but they don't want to disclose it because they've got enormous vested interest in withholding all that information. And I'm still waiting for the our debate with your new best friend, Miss Morgan, Martin. That said that numbers won't affect. Listing numbers won't affect prices in Sydney. I'd like to know in what suburbs. So, and she can pick the suburbs, and I'll do that for you. How's that? I'll be gentle. I'll let her pick the suburbs, and we can discuss it on her terms. How's that?
Sounds like a bargain to me, Edwin. Look, as always, very insightful conversation with you today. So thanks for taking the time to make this show. Looking forward to the weekly events on a Monday from this point forward. And, we'll get the first one out next week and start talking about the numbers and how it's going. What we might also do is we might use a few more examples of where prices have dropped. So get real and show real examples as part of the conversation, because I find that one of the most powerful ways of demonstrating what's going on. My final point is, there is no doubt in my mind that some people will still and should be buying even at the moment, but not thinking prices are going to go up. You're buying for other reasons. You're buying because you need to move, or you're buying because you're looking for long-term security and you want to own a place, right? So there is still a market there, but it's not being defined as typically it was, with massive acceleration in prices. You can never lose out. Interest rates are so low. People have got to be much more balanced and much more rational about the decisions they take. And if we can help them make better, more rational decisions, then it's a win-win.
Yeah, exactly. Look, they're going into, and I think it's not just about property prices as much as what we talk about, also about the how transactions occur and what happens. And if I can help you prepare, if I can equip you or equip our listeners, our followers, to go into a battleground, with as much ammunition as possible. It's very, this property transacting is very adversarial. So you either have somebody that has the same knowledge or more knowledge than the opponent, or you better equip yourself with the same knowledge or more knowledge than your opponent, and because your opponent's being on the ground, on the field, and they theoretically they hold the cards. But it's how we can turn that around in your favour, and this is what we do with our clients as well. We turn that around in order for our clients to buy below, way below what the guides are, and take advantage of different things. But like we said, some people they want to buy, they have to buy for other reasons as well.
Indeed. Well, Edwin, thanks for that. And I always say forearmed is forewarned, or forewarned is forearmed, whichever way around you like to put it, right? The better information sources you have, the better you understand what's going on, the better you understand how the industry works, the better you have a chance of making a good decision, whatever that decision is. And so we will continue to help and hopefully guide some of those, not providing specific financial advice, but generally talking about the industry and talking about some of the trends. So thanks for your time today, and we'll talk again next week.
Sounds great. I'm looking forward to it, Martin.
Thanks, Edwin. Take care.
Cheers.